Very quick introduction. So, which is your company and what's your investment strategy and what is your LP base? And we'll start from there to the benefit of the audience. So, Marc, you want to start?
I'm investing for Schibsted. Schibsted is a Norwegian group based in mainly Norway, Sweden, and France. As regard investment, we have only one LP because we are an industrial investor. And our strategy is to complement our business models that are in publishing and classifieds with new models where we can ramp up the companies using the assets that we have.
Nenad Marovac, DN Capital. So we invest in software, digital media, mobile, and e-commerce. So we have about 200 million euros under management. We operate in the UK, Hello. And also Silicon Valley. Some of our companies are Shazam and Deca.
Hi, so I'm Martin. I work for Index Ventures, which is a European-based fund which invests both in Europe, Israel, and in the US, both on the East Coast and the West Coast. We just announced this morning that we raised a new early-stage fund of 400 million euros, investing in seed, Series A, and Series B companies. And we invest in both kind of web infrastructure companies in storage, database, and all the way to much more light-touch consumer startups in e-commerce, in gaming, and everything kind of in between.
I'm Jan Schultze from Acton Capital. We're based in Munich. We're a late-stage growth fund. We purely invest in internet-enabled businesses, even more focused on what we call consumer internet companies. We have been doing this since 1999. We originate from one of Germany's media groups, Hubert Boda Media, where we invested till 2008. Overall, we have invested in around 60 companies, more than 300 million euros, quite a few of them having become household names in Germany. We invest about 2/3 in Germany and 1/3 in Europe and in North America, specifically in Canada.
I'm Philippe Collombel from Partech. Partech operates out of Silicon Valley, Berlin, and Paris. And we invest around 1/3, 1/3, 1/3. 1/3 Central Europe, 1/3 France, and 1/3 Silicon Valley. We have been around since 1982. In fact, the most experienced VC operating in Europe. With over last April, we celebrated our 21st IPO, 5/9 on the Nasdaq. We do mainly early stage and seed, but as was announced this morning, we are about to close a pretty large growth fund as well.
Okay, thanks a lot. I'd like to start with one thing that is in the report we circulated earlier on, which is the fact of having some pan-European GPs. So we see a lot of local players, but I have the chance here to have some also pan-European or multi-country funds. So maybe Nenad, what's your take about investing around Europe, so covering more than one country? I mean, what are the things that have worked for you well, and what are the things that make this a bit complicated?
Sure. I think it works if you're focused on verticals. So you really understand enterprise software, or you really understand e-commerce or mobile. I think it's much harder to do if you're trying to be a generalist and then go everywhere. So I think for us, if we see an e-commerce company in the UK or Germany or France or Sweden, we look at the same metrics that we apply anywhere as in the US. So for us, it doesn't matter. And the quality of the team. So for us, it's really not an issue. Obviously, we have a partner in Silicon Valley in Palo Alto. We have people in London. We have people in Berlin. So that's why we focus on these markets. So
if I'm right, there is an issue of having a local network, and so either via venture partner or historical relationship.
Sure. So we don't like I've looked at deals in Russia, and actually we thought about doing Russia for a while, and it takes 3 days to get a visa. It's a 4-hour flight. It's 2 or 3 time zones. It just doesn't make sense. right? For us, if we had someone in Russia, maybe we'd do it. But that's kind of how we look at it. I mean, Berlin's easy; it's less than a 2-hour flight. So is everywhere else in Europe. Once you start getting into Israel, Turkey, Russia, it's a different ballgame.
I have a question for Philippe, still on the same subject. Is it more difficult to invest in the US or in Germany for being a French VC originally?
It's a tough question with a simple answer. As we were born in the US, it's much simpler to invest in the US, in fact. It has changed since we made 3 or 4 landmarks investment in Germany. We did Brandsma for France, we did Quipe, and since then we are considered as serious investors. It has changed also since 2012 because we have an office there. I fully agree. What I find difficult, and I admire this guy for flying in, flying out of Berlin, because I had a board in Berlin. We had Friday afternoon board. 50% of the time I had to spend the Friday evening in a Berlin hotel because of the snow in the winter. But if you have a local team, first you can drink beer at night, you are part of the events. That is much easier to have access to the ecosystem. And for us, it has been a big change to have an office as compared to before, where we're flying in, flying out. That's the limits of the model. You can't have 10 offices because then you have an issue of coordination among the partners. If you don't have an office, you have an issue of deal flow. As we all know very well, VC is not a very scalable business model.
Martin, maybe to you, I mean, you have joined a firm which was, I think, the time you joined was already global. So, I mean, how is it like trying to invest in different geographies? I mean, what are the things that are done well in Index in order to let you operate as a real global player?
Yeah, I think so. When I joined Index 5 years ago, we didn't have an office in San Francisco yet, which we opened the office there 3 years ago. But we had already a lot of investment on the West Coast. And I think one thing that helped us is a cultural choice from the very beginning. Is that the team was kind of US educated and had started to work in the US, so had a very strong network in the Valley. And also the firm started in Geneva. And the good thing with Geneva is that if you don't fly somewhere, you're not going to have much deal flow. So from the very early days, we had to fly into geographies where a lot of people didn't really spend time. So and that's really how we did Skype, which was kind of between Sweden and Estonia. That's how we did MySQL, which was between Sweden and Finland. So geographies where there weren't like some very big continental Europe investors being active. And yeah, I think obviously traveling is probably the only drawback of being a VC in Europe. But apart from that, it's a great job, so it's not too bad.
Thank you, Marc. Tell us a bit about your team. I mean, you are covering probably 3 different geographies, or maybe more.
Yeah, our geographical expansion strategy is mainly driven by the fact that our model calls for a lot of synergies. We are an industrial investor, though we only look at markets where we can really deliver a lot of synergies with the businesses that we have locally. That's the reason why we started in Sweden, where the group is very powerful in media and classifieds. And it's been started mid 2006, 2007, where they set up a team to do investments, and then expanded in Norway in 2011 and in France 2013. Just because, why so late in France? Because the market in France is comparatively much larger than it is in Scandinavia. But it took time for Le Bon Coin to become the leader in the market. And once the position has been established, then we decided to go for investigating companies that could be invested in to complement Le Bon Coin and use Le Bon Coin as a growth engine. So that's the reason why we mix both things. We mix the interest of the local scene, of the local ecosystem, as a key driver, plus the synergies that we can deliver.
Okay, maybe just to close the round with Jan, I feel like you are more focused on the local German market, but I might be wrong, so tell us a bit, I mean, what's your view on that? Germany is enough for you?
Well, Germany is still fourth largest economy in the world. There aren't really that many venture funds in Germany, but there is a great ecosystem evolving in Berlin and Munich and Hamburg. A lot of companies being built. There is a lot of entrepreneurial money, either coming from former founders or people who are just interested in the sector, who fund these businesses on the angel seed stage or early stage. We are, as of now, the only late stage fund who is really focused on digital. And we have always, therefore, invested in Germany, although we evolved. We are evolving basically with the sector. We are a sector-focused fund. And we started off as seed and early stage investors, and today we are late stage growth. If we do international investments, we do them actually fairly opportunistically. We are fairly well connected in the meantime in Scandinavia. We did an investment in Russia. We have done a number of investments for certain reasons in Canada, and we like to do these with local partners who know their way around, and that has been so far for us a successful formula.
Okay, good, thank you. Maybe I'd like to take another finding in our report, which I believe is quite important. It's about the financing value chain. I mean, is it true that if you have an unbalanced value chain, this could affect the strategy of companies, and therefore one of the reasons why we are unable to create unicorns in Europe is that the final bit is missing, so the late stage is missing, and therefore entrepreneurs tend to adopt more, say, cautious strategy in terms vis-a-vis growth. I think Philippe was talking about this this morning at the round table upstairs, so maybe if you can elaborate a bit on this one.
That's true that there were very, very few growth stage funds up to recently. I mean, growth stage, that means there was Axel, there was of course Index, there was some others, but when you look at the statistics, it's striking. Around 50% of the growth stage companies were financed by US capital in 2008. Now we are at 70%. And when you see the absolute numbers, it has gone up by 20%, meaning that there is a clear lack of capital. But when you say the final stage, I think what is deeply missing is trade sale by very large corporate, because trade sale by a very large corporate creates new money to be invested. That's basically the model of the Silicon Valley. I think all of us are obliged almost to sell our company to US companies when it's a straight sale. There is a huge price gap between the price that a US corporate is ready to pay and a European corporate is ready to pay. That's something that we need to acknowledge, with a huge exception. It's a German company. Springer has done a tremendous job. I think we must all take that into account. But when you look at the strategy of most corporates in Europe, they just don't want to pay the right price. And the right price is the right price for the entrepreneurs, but it's also the right price for the VCs. We don't print money as far as we are concerned.
I think that's definitely an issue, but I think another issue is that when there is a buyer, the first time the buyer shows up, the European entrepreneur is like, I want to take it. I want to just get that 20 million or 30 million, and I don't want to go for the billion. And that is the hard part.
But that's a bit chicken egg problem. So is it because of the fact that European entrepreneurs lack of ambition, or because there's very limited offer?
And can I say something really controversial? The VCs aren't rich enough.
Yeah.
Okay? Because they're also thinking, fuck, I haven't had a lot of exits. I haven't made much carry. I'm not, John Doerr or Michael Moritz, where I've already, made, billions or whatever. So they're also, buyers don't show up all the time, right? I mean, we all know here, if we're at the table, that when a buyer does show up, you better take attention, right? Because it's not, they don't always show up for all of our companies. So The question is the asset good enough that you raise the growth capital, which you need? Because if the buyer comes up and you say no, you need to go raise 50 million right away to compete, because he might buy your competitor and put $100 million bucks in him, right? So you have to play big time. And you know, are you confident enough with your team, the market size, opportunity, et cetera? So that to me is, and obviously the market, the VC market in Europe has evolved tremendously. I mean, I think Axel and Index have really created the market. Everyone else that was around before them, except maybe you guys, is pretty much gone in Europe, right? A lot of the big names that we talked about in 2000 in venture in Europe, they're nowhere here. I mean, you have like the scrappy fighters like Sitar in the audience that, you know, are going to kick our ass in a couple of years. So I think, you know, that's to me and you know, I face this currently on a couple situations, and it's a tricky one.
But I would like to take probably a slightly different view, because if you build a business in Europe, it simply takes a lot longer to build a billion-dollar company. And if you count the number of billion-dollar companies in the US and in Europe, it isn't really that many that people always talk about. And I think we have to get away from this billion-dollar formula. In the US is factor 5 of Germany. If you scale a business in the US and it's successful, yes, it becomes a billion-dollar company, and it goes much quicker than it does in Europe. So I think what we are observing in the kind of investments we are doing is that there's actually a player now moving quite aggressively into the field. That's the traditional private equity funds. They have realized that they need companies that grow. They have the capability of bringing these companies from Europe to Asia and the US. They have capital that they need to deploy. And we have done an exit last year, which went to a large private equity company. We're currently in a process where we see significant demand from the private equity side. Probably these guys don't pay the multiples that our American friends get at the stock exchange. That's why we shouldn't get crazy about throwing too much money at our ecosystem, which I think at the moment is actually really starting to become a very balanced and well-working ecosystem. I think, let's face it, the people who are here in the room, these are the survivors of a significant crisis in 2000, which basically wiped out this little flower of venture capital that started to flourish and then was dumped with stupid money. And in the end, a lot of money was lost. And the people who are sitting here, they have raised 1, 2, 3 funds, 4 funds, and they're doing good investments. And I think we will see great exits in the coming months and years. We hear already from great exits. There are billion-dollar exits in Europe. So I think we should not always put ourselves as we are not as successful as our friends in the US. That country is just 5 times bigger, and that makes a huge difference. And let's keep that into account.
Okay.
Yeah, obviously the lack of trade sale is a big issue. It's also just a factor of in Europe, just a factor of the fact that the ecosystem is just much younger, and it's probably going to change. Because if you look at the trade sale in the US, they're mainly done by tech companies, and we just don't have large tech companies in Europe yet. But if you look at Criteo, for example, they are starting. You know, they've already made, since the IPO, they've already made three acquisitions in Europe of startups at 20 to 50 million kind of range, which is small, but that's exactly the kind of liquidity that you need. Quick exits that kind of start generating liquidity and some more wealthy founders that can become angels. So over the past 12 months, we had $7 billion exits, billion dollar plus exits, 5 of them from European companies, King, Criteo, Supercell, Just Eat, Zendesk, and all of these companies are going to become buyers of startups, and that's how we get started. But we're just, I guess, a bit behind in time-wise, but it's changing.
But maybe talking about, unless Marc, you want to add something to this specific subject.
Yeah, just a word in defense of the corporate world.
I was going to, yeah, okay, go ahead, sorry.
Like, as I'm the only one here having this hat, I think our analysis at Schibsted is that a capital that is deployed early in companies and that we leverage using our assets is a much more efficient way of investment than buying full price at a late stage. It's basically the case. And so our strategy is basically an industrial investor just making the best investment possible, the best use of capital. And remember, we don't have LPs. I mean, it's our cash. It's the cash that comes from our operations. So it's pretty expensive. And so, in a sense, I would say I fully agree with what you say. But look at the European scene. I mean, you as Martin said, let's the ecosystem evolve and let's new leaders come out of the whole development of the ecosystem, and then we'll see something that will more or less emulate whatever we all think about that is the ecosystem in the Silicon Valley or in Asia. But it takes time, and I don't think that just thinking about the corporates as being just dumb cash pipes that buy anything and everything at very high valuations is the right approach to a successful and very growing exit scene.
Maybe still on this one, I have an additional question regarding corporate. According to the report, another thing that makes more difficult to get European corporates to buy companies is that even from a cultural standpoint, they have less habit to actually take over and acquire external innovation and integrate. And most of the time, they've been not that good in integrating in external innovation. I mean, could you? I mean, do you think is it the case? Maybe more on a general. At the general level, and have you ever heard the experiences of industrial exits, that at the end proved to be unsuccessfully or relatively unsuccessfully because of this lack in being capable of integrating external innovation?
Because we do M&A as well. We have a M&A team in Oslo that is doing M&A on a corporate level for the media and classified parts. And what we do is we buy locally. We only buy if we have teams on the ground that can make evaluation of the business. We don't buy from a remote area where you just evaluate the company based on Excel spreadsheet. Doesn't work. So basically, is there? I cannot really comment on that because we don't have a very long history of buying companies. It's much more opportunity based in geographies where we are. But on a more general terms, as you asked the question, the thing is we all know M&A failed most of the time. When big companies buy startups, it's a failure. It's a sure failure 60% of the time. So, I mean, I think that corporations in Europe have finally integrated that it's very hard to integrate startups.
I mean, is it really hard? I mean, Google has been doing a number of acquisitions, which is amazing.
How many Googles do we have in Europe?
No. I'm just saying. I'm not saying we. It's just for the sake of understanding whether, from a cultural standpoint, we do have an issue in Europe which goes beyond the fact of being acquisitive, and which is about: am I capable? Am I organized to actually buy a company and do something with what I buy? I mean, Google seems to be a company capable of integrating.
But do they
several companies.
And do they have the cash, even more importantly, right? I mean, Google, there's a cash printing, they have monopoly on information globally. They are printing money, and they are very highly valued, so they can buy companies for cash and shares very easily. I mean, European companies have low margins, and we are going to come back to them, and that brings us to another issue, which is much more, which is much broader and much more structural, but I think that's the first question. Plus, how many? The real question as well is how many non-tech US companies are buying tech companies? Exactly. So last year we sold a company called Climate Corporation to Monsanto, and everyone was like, "Wow, what is Monsanto doing a tech company for?" So it seemed to me, I don't know the market very well, but it seemed to me it was still an exception. So the main difference is that we don't have those tech companies. which are large enough and profitable enough to make those acquisitions in mass, I suspect.
If I may just support that point, Google is coming from the environment we're investing in. It has become an incredible company and has huge cash flow and therefore is capable of doing these kind of investments. If you look at the corporate world, for example, in Germany, and you look at the media sector, there have basically been two media groups who started to invest in the late 90s into the sector. One was Burda and one was Holzbrink, and then later Springer came, who started to invest at a much larger scale into already fairly advanced companies. So three groups have deployed significant amount of capital into the ecosystem, and they were corporates. I think it shows, and by the way, not a single US media company succeeded in doing that. So a company like Burda today does 50% of its revenue from digital. And there isn't a single company in the US who were able to do that. So I think, I'm sure there are examples in France, in Spain, in Italy, where corporates have done that. I think your point is absolutely valid. Schibsted, the Scandinavians are great in doing it. And we have examples in Europe of that kind of stuff.
Yeah, I would like to comment on that. I think if you have a great company, so we're investors in OLX, which was sort of a European-American company, and you guys were one of the potential buyers for that company. So that was a European buyer that could have bought it. Naspers ended up buying it in the case. But I think, there's a lot of the challenges, but actually the market today in Europe is better than it's ever been. My partner's in Palo Alto, and there's 500 VCs on Sand Hill Road. There's like 25 or 40 guys in Europe that really matter in this market. We have the best market. I mean, I don't know why everyone's complaining. It's fantastic right now. Look at Index. 7 billion-dollar exits, 5 out of 7 in Europe. And this is better than any Silicon Valley firm's track record in the last 12 months.
Yes.
So, come on. It's true.
No, but I think what is very true is that it's an ecosystem which is very, very young, in fact. We are survivors, but I think when you look at the industries, the entrepreneurs are more and more often very ambitious. We had a lack of ambition. We had a lack of ambition. We had a lack of ambition. I think it had changed. That means that the only thing that I will disagree with is that I think we need to shoot for $1 billion exit, because that's what will make this industry. Some corporates, such as Springer, have shown that you can make successful integration. You also need to consider that merger between huge companies are also failing quite a lot of time. Look at Publicis. They had to give up because they couldn't even work on the integration plan. Fourth, I think also, in a way, some of the corporations were, in a way, too shy. I have a lot of examples of corporates buying 3 or 4 50 million euros companies because the CEO knew that if it failed, he won't be fired. Whereas if he makes a 500 million check, that is another story. And I think we all know that it has happened in the past. It's changing, but it will take time. It will take time as well. And you also need to consider that from the corporate world, we were very, very strange animals only 5 years ago. We were seen as people playing with money, trying to disrupt an industry. And now we have all of the big corporates know that they can be destroyed. Look at the hotel industry. They had to face with bookings. They were trying to understand what is happening. And suddenly Airbnb happens. And the other part of the value chain is being destroyed.
Of course, Uber.
Yeah. No, but and I think that's very, very new for most of the industry sectors. And I think it will make a big impact in the 5 years because they will take us seriously. They understand that we are going to build real companies.
Thank you very much. I think it was a very interesting exchange. We just have 4 minutes left, so if there are any questions from the audience, we'll be happy to take one question. They're too shy, like corporate. Yeah, there is one.
One comment about media companies. I've been myself working a long time for European media companies, so I know a little bit of the field. There seems to be a cultural divide between Northern and Central Europe. I'm speaking about Germany and Scandinavia, about innovation and corporate development against companies in the south of Europe, Italy, Spain, France, for example, which are slower to adapt, to adjust themselves to innovation than the companies in Northern Europe. How can we explain that? Is it a cultural divide? Is it a lack of innovation in Europe, in Southern Europe? Or?
I don't think there is such a divide. I mean, all the interesting companies in Europe are multinational by principle. I mean, they're all present in all the European countries. They're present worldwide, in the United States, in Asia. So why would they have a different cultural mindset? I mean, all the managers are European now, and I don't see really a difference between maybe the Nordics and UK and Germany maybe have a bit longer experience in managing corporate growth and development and merger and acquisition and building global groups, but I think it's a couple of years of difference, but it doesn't make a huge divide.
And also some of the most I think the most ambitious entrepreneurs travel in Europe as well. And if you look at King, Riccardo is an Italian founder, and they moved to where the best places in Europe to start a company, because I think the mindset is not different across culture. It's just like the local political or tax environment may be different. But then the good thing in Europe is that you can very easily set up in London or Stockholm or Paris or Berlin if you're not happy where you are, and then start a $1 billion company from there.
Hi. So I guess not every investment pays off. And what matters is that the ones that are successful are really, really successful. Are we tolerant enough of people that are really, really successful in Europe? And in France in particular?
What do you mean by tolerant? I think it has changed quite a lot. The people that make the headline in the press are Niel, Simoncini, Grandjean. I think it was impossible 15 years ago. I don't think Rudel is seen as a crook. Let's face the realities. The world is changing. When you look at the business school and the engineering school, 10 years ago, they all wanted to do investment banking. When you look now, 1/3 of them wants to become entrepreneurs. It's a huge cultural shift. I am pretty optimistic. Nobody is complaining anymore that people are becoming rich.
I would just add on that, if you look at the UK, Brent Hoberman, who started last minute, now started something called the Founders Forum, and getting all these founders together, and they're starting companies together, they're angel investing, they're also starting VCs, so ProFounders and Atomico, et cetera. And then if you move to Berlin, I think the best thing that ever happened to Berlin is Oliver Samwer, okay? And he's very controversial, but the training the people got from Ollie, working with Ollie, has created so many companies. It's created the best ecosystem in Europe in terms of companies coming out of one company. So it is the European PayPal mafia. Sort of equivalent is Rocket. There's no other company that's created as many spin-offs. Even Skype hasn't come close to what Rocket has done in terms of creating new companies. So, you know, Ollie's a controversial guy, but I think he is, you know, a true leader in this industry, and there should be a little statue of him in Berlin.
I think I would just add one last controversial thing, if I may.
Okay.
I think there is just there is like a political schizophrenia in France and in other countries where, you know, the state is very indebted and needs to raise money to keep functioning, and so needs to tax heavily. And capital is it's a good way. It's an easy thing to tax, you know. So I think there is a speech which is about to say we need to reduce inequality, but I think it's mainly an excuse for taxing capital and taxing rich people in a way and making it acceptable. But the reality is that politicians, when we hear this morning politicians supporting crowdfunding and everyone being a capitalist in a way, they realize that actually, most people want to succeed, want to become rich, want to start very big companies, whether they're French, Italian, Spanish. If you start a company, it's to create something very big. And if you invest as a personal investor in a company and a crowdfunding, it's probably to make a return as well. So there is that kind of, I think there's a kind of a schizophrenia between the reality of what people of what people really believe and what people have to say. In order just to because we need to keep the state in working. So I think that's more of a political sort. But deep inside, I think everyone kind of shares the same dream.
Okay, thanks a lot. We need to move to the next one. Thanks to